Jesse Livermore made and lost millions of dollars multiple times in the early 1900s trading stocks before computers, before the internet, before TradingView even existed. He did it all with ticker tape and his brain. Now, you'd think that a guy from 100 years ago wouldn't have much to teach modern traders with their algorithms and instant execution and 5,000 indicators. But here's the thing. Markets change, technology changes, but human psychology hasn't evolved at all. The same emotions that destroyed traders in 1929 are destroying traders today. Livermore figured out how to navigate those emotions and extract money from markets for decades. And the lessons he left behind are still more valuable than 90% of the trading content on the internet. Today we're breaking down the 3 most important lessons from Jesse Livermore's trading career, and more importantly, how you apply them right now in modern markets. No history lesson, no nostalgia, just practical wisdom from a guy who made and lost millions multiple times and left us a roadmap for what actually works. Let's get into it. Livermore had this concept he called the line of least resistance, and it's one of the most important ideas in trading that almost nobody actually follows. He said the market will always take the path of least resistance, and your job as a trader isn't to predict where it should go or where you think it will go, but to identify which direction has the least resistance and go with it. Sounds simple, right? But here's what he meant, and more importantly, how you apply it today. The line of least resistance is where the market wants to go naturally. It's the path of least friction, the direction where buying or selling pressure dominates. Livermore didn't fight this. He didn't try to pick tops or bottoms. He didn't care about whether a stock was fundamentally overvalued or undervalued. He asked one question: which direction is price moving with the least resistance? Then he went with it. According to research on trend-following strategies, this principle of trading in the direction of least resistance produces positive expectancy across multiple decades and market conditions. The market tells you where it wants to go through its behavior. Your job is to listen, not to argue. The practical application is simple but requires discipline. You trade with the dominant trend on your time frame. If the daily chart is trending up, you look for long setups, not short setups. If the market is clearly trending down, you look for shorts, not longs. This sounds obvious, but most traders spend enormous energy trying to pick tops and bottoms, trading against the prevailing direction because they think they're smart enough to call the turn. Livermore understood that fighting the direction of least resistance is expensive. According to research on trend-following strategies, traders who align positions with the dominant trend have win rates approximately 15 to 20% higher than those who attempt to pick reversals. The practical application is simple but requires discipline. Before every trade, ask yourself one question: am I trading with the line of least resistance or against it? If you're buying in a downtrend or selling in an uptrend because you think you've spotted a reversal, you're fighting the path of least resistance. Sometimes you'll be right, but you're taking low probability trades. The path of least resistance is the direction price moves most easily, and that's the direction that should align with your position. According to research on trend-following strategies, trades taken in the direction of the prevailing trend have approximately 15 to 20% higher success rates than counter-trend trades, even accounting for the fact that reversals do occur. Livermore also understood that markets have memory and momentum. A stock in motion tends to stay in motion until something significant changes. This is essentially Newton's first law applied to markets. When you fight against the current direction by trying to pick tops and bottoms, you're fighting momentum, liquidity, and market psychology. When you align with the trend, all those forces work in your favor. Modern research on momentum effects in financial markets confirms what Livermore understood intuitively over a century ago. Trends persist more often than they reverse. The practical application is that you need to become comfortable trading in the direction of the larger trend and patient enough to wait for the market to show you which direction that is. This doesn't mean you can't trade counter-trend strategies, but it does mean you need to acknowledge you're fighting against the prevailing force and size your risk accordingly. According to research on trend-following strategies, approaches that align with the dominant trend have win rates approximately 15 to 20% higher than strategies that trade against the trend. Livermore also understood that major moves often come after periods of accumulation or distribution that most traders miss because they're impatient. He would wait for what he called the line of least resistance to become clear before committing capital. In modern terms, This means waiting for the market to show you which direction it wants to go rather than predicting which way it should go. The market will tell you what it's doing if you're patient enough to listen. The application here is simple but difficult. Define what your favorable trend looks like. Is it price above the 50-day moving average? Is it making higher highs and higher lows? Is it a specific momentum indicator reading? Whatever your definition, make it objective and then only trade in the direction of that trend. When the market is clearly trending up, only look for long setups. When it's trending down, only look for shorts. When it's not trending clearly, sit on your hands and wait. According to research on trend-following strategies, traders who remain inactive during non-trending periods significantly outperform those who try to trade all market conditions. The market will tell you when it's ready to trend. Your job is to listen and wait rather than impose your will. Livermore's second critical lesson was about asymmetric risk management. He famously said, "It is literally true that millions come easier to a trader after he knows how to trade than hundreds did in the days of his ignorance." What he understood was that profitability comes not from being right more often, but from making more on winners than you lose on losers. This is the foundation of expectancy in trading, a concept that most retail traders still don't grasp over a century after Livermore figured it out. The theory here is simple, but the execution is brutal. You must cut your losses quickly and let your profits run. Research in behavioral finance consistently shows that retail traders do the exact opposite. They hold losers hoping they'll come back and cut winners early to secure profits. This inverted behavior is driven by loss aversion, the psychological tendency to feel the pain of losses more intensely than the pleasure of equivalent gains. According to prospect theory developed by Kahneman and Tversky, losses hurt about 2.5 times as much as gains feel good, which creates a powerful bias toward holding losers and cutting winners. Livermore understood this psychology a century before the formal research existed. He wrote that the big money wasn't in the buying and selling, but in the waiting, in holding positions through discomfort to capture large moves. Modern trading psychology research confirms his insight. Studies show that traders who cut winners early and hold losers too long underperform by significant margins compared to those who do the opposite. The discipline required to let winners run while cutting losers quickly goes against every instinct, which is exactly why it works. Here's how you apply this lesson practically. First, you need objective exit rules that aren't based on your emotional state. Before you enter any trade, you decide 3 things. Where's my stop if I'm wrong? Where's my minimum target if I'm right? And under what conditions will I let it run beyond that target? These decisions made in advance, when you're thinking clearly, protect you from the emotional interference that happens once you're in the position. Second, you need to physically separate yourself from the ability to close winners early. Some traders literally use limit orders at their targets and don't watch the position. Others have rules like I cannot exit a winning trade until it's been open for at least 4 hours, or whatever time frame makes sense for their strategy. The specific mechanism matters less than creating friction between the impulse to close and the action of closing. Research on pre-commitment strategies shows that people who create obstacles to unwanted behavior are significantly more successful at avoiding it than those who rely on willpower alone. Third, you need to accept that letting winners run means watching them give back profit sometimes. Livermore understood that the big money is made catching the big moves, and you can't catch big moves if you exit every time price retraces slightly. This requires emotional tolerance for paper profit volatility. The modern application is trailing stops that lock in some profit while leaving room for larger moves, but the principle remains. You have to be willing to give back some unrealized gains to capture the exceptional winners that make your year. Jesse Livermore traded over a century ago in markets that looked nothing like today's markets. No computers, no high-frequency trading, no options chains. Yet the lessons he learned and shared remain completely relevant because they're about human psychology and market structure, both of which are fundamentally unchanged. Cut your losses quickly because hope is expensive and losing trades rarely recover. Trade with the trend because markets move in observable patterns that persist once established. Let your winners run because a few large gains can overcome many small losses. These aren't complicated lessons. They're actually painfully simple. That's what makes them difficult. Simple doesn't mean easy. Cutting losses quickly is simple, but emotionally brutal. Trading with the trend is simple, but requires patience to wait for the trend to establish. Letting winners run is simple, but fights against every instinct to secure profit before it disappears. The lessons are simple. The execution is where most traders fail. But here's the encouraging part. Livermore proved these principles work. Countless traders since have proven the same principles work. The only question is whether you'll apply them consistently in your own trading. You don't need to invent new methods or discover secret patterns. You need to master the fundamentals that have worked for generations. Cut losses. Trade with the trend. Let winners run. Do those three things with discipline over hundreds of trades, and you'll have an edge that compounds over time. That's Livermore's gift to us. Not complexity, but clarity. Not secrets, but principles. Take them, test them, and make them your own.